Hello there, and welcome to the second of two videos which accompany our latest quarterly report. In the first video, we looked at how Mr. Trump and his tariffs have been moving markets and the economic outlook and how that's been changing really from one day to the next. In this video, we'll look at how all of that has affected portfolios and some of the things we've been doing within portfolios to try and protect them, and some of the other things we've been doing to try and take advantage of those market lows. The first thing I will say is that portfolios have generally held up really well despite the steep falls in stock markets. So this chart shows the balanced portfolio in blue over the last year compared to the typical mixed investment fund in red. And this is up to 15th of April. And you can see that over the 12 months, the portfolio is still up more than 2.5% despite the recent falls in stock markets. So you may recall from our last video that at one point the S&P 500 was down more than 20% from its peak. Well, rest assured our portfolios fell a lot less. The balanced portfolio in this instance fell less than the mixed investment sector, and you can see it's also bounced reasonably well, and actually our more cautious portfolios held up even better. So this next table I'm going to show you is from our quarterly report, but again I brought it more up to date, and now we're looking at returns up to 15th of April. So this shows the calendar year returns of each portfolio compared to the average similar fund over the last 10 years. So as usual, the green numbers show where we've outperformed. Now I particularly like to draw your attention to the year-to-date numbers, and here you can see that cautious, balanced and defensive have all outperformed because they've fallen less than the typical fund, and they're only down roughly 1 or 2% since the start of 2025. As we would expect, however, adventurous and global equity have fallen a little bit more, but that's not unsurprising at all. They do take more risk, and as a result they tend to outperform when markets go up, and we can see that if we look at last year's performance, which was very strong in 2024. In fact, as you can see, all of the funds outperformed their benchmarks last year. So despite all of the headlines, the first things to say is that portfolios have held up really well. Things really don't look that bad, and the long-term returns still look pretty good. If you want to see more details of the long-term returns, please do see the written report for a lot more detail. In terms of positioning, for some time we've had a bit less than usual in equities in the core funds, being particularly concerned about the US, and we had more than usual in bonds and things like defined returns. So all of that has helped returns. And one other thing that has helped returns in the short term is the portfolio insurance that we've talked about in previous updates. Essentially, a portfolio insurance is what we call a put option. We've essentially taken out an insurance policy by buying a product that will essentially go up in value should the stock markets fall significantly, as we've seen more recently. So this is essentially designed to mitigate the losses in the event the US stock market fell. Because of how it works, it was only a small part of the balanced portfolio, just 0.3% of the portfolio as of 1st of April, but it's done exactly what we thought it would do. As stocks fell, it went up significantly, and that meant the position in the portfolio increased from 0.3% to about 1.4% of the portfolio as of the lows of 7th of April. So essentially what that means is that's offset some of the falls in our equity holdings. We were then able to sell part of that at a big gain, bank that gain and make that cash available to reinvest, and that means we've got some cash to take advantage of any opportunities that we see. But we do still hold some of it in case we have further pullback in markets. Now we already had a bit more cash than usual in portfolios because, as I said, we were feeling a little bit cautious coming into this. And we've added to that more recently by reducing some of the risk within the fixed interest part of the portfolio. Now, an asset class we've really liked over the past couple of years has been high yield corporate bonds. And this is essentially where you lend money to a company that has a little bit more risk than the typical company, but as a result you get paid a higher level of interest, a higher yield, and we felt that those bonds look really attractive, so we've had quite a lot of those in the portfolios. We've been reducing them so far this year, and then as we came into this kind of period of turbulence, we did what we often do. We sold a big chunk of those bonds down into cash. And essentially, because they're slightly higher risk companies, they can be quite sensitive to changes in the economy. So it means that high yield bonds tend to sort of go in the similar sort of direction to equities, shall we say. So when equities fall, high yield bonds quite often can fall as well, but sometimes a bit later and not usually as far. So what we often do in that sort of situation, as soon as equities start falling, we sell those high yield bonds and try and mitigate some of those potential downside risks and make cash available to reinvest. All this means is we now have over 5.5% in cash within the balance fund. We've also got over 13% in short-dated fixed interest funds. And these are the ones that sort of tend to be a lot less volatile than your typical bond fund. Because they're so short-dated, short time till maturity, they are less susceptible to the economic outlook and to changes in interest rates. So on the one hand, we've tried to make the portfolios a little bit safer to protect against further falls. But on the other hand, of course, we want to try and, as I said before, take advantage of those market lows. And that's what we've done more recently by buying a new defined returns product. So this chart shows the FTSE 100 in blue and the S&P 500 in red so far this year. Now, we've struck a new defined returns product on 4th of April, and we've marked that on the chart by showing this dotted blue line. That product was created after the markets had already fallen a long, long way. So you can see that we're buying at a relative low compared to where we were a few months ago. Now this product will give us a return equivalent to 13.5% per annum should these two markets just be at or above their starting levels at any one of the specified kick-out dates every 6 months over the next 5 years. Now we really like this product for a few reasons. Firstly, because the potential return of 13.5% per annum is really attractive. And secondly, because we managed to get in at a level on the S&P 500 almost 20% below where it had been a couple of months earlier, almost 10% below for the FTSE. And even if this volatility continues, even if markets go down in the short term, all we need for this product to be successful is for those markets to be at or above those levels at any one of those 6 monthly kick-out dates over the next 5 years. So even if we admit we haven't got a clue which way markets are going to go over the next few months, we'd be pretty confident that at some point over 5 years, those markets will be back above those levels where they are today. If so, we get a really nice, really attractive return. But if markets do take a further dip from here, we've got that cash available and we can deploy that to try and take advantage and buy some things at the relative lows. So perhaps we might do another defined return product, or if markets go even further down, we might just buy some equities directly. Now, of course, this is very much a fast-changing situation. It will probably have changed again by the time you actually watch this. And as usual, we will try and keep you up to date as much as we can. So if anything significant happens, we'll issue some further communications and let you know what's happening. But rest assured, we're watching things carefully. There are things that we can do, and there are things we've already done to try and, as I say, protect portfolios to give us the chance to buy things that are low, and that should help longer term returns as well. So I hope you found these useful. Please do get in touch if you've got any comments or queries, but we'll see you again next time. Thank you.